presentation contains current opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Mo's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compak Asset Management YouTube update for May the 16th, 2023. I'm Mo Ansari, President of Compak Asset Management, host of Market Wrap, and you can get all the daily broadcasts, you can get this YouTube update, you can get the mobile app, all of this available at compak.com/media. Just go to the media page, compak.com/media. It's right here at the bottom, right there, that you can type that in. And that will get you all of this information. And you can download the free app too. And then you can get the daily broadcast also. So don't forget to do that. I'm going to talk about the Fed, the market a little bit, the economy, technical analysis, and then look at the week ahead. Let's start with the Fed. The Fed, it's just sitting and waiting. What are they going to do in June? That's the question, a big question. There's a 75% probability on the futures market that they're going to leave interest rates unchanged. That means they're not going to raise interest rates, or they're going to hit what is called the pause button. At this point, that 75% changes very, very quickly. In one day, it can go from 75 to 20%. So I don't pay a lot of notice to that. We did get inflation data last week. It was as expected, not very good, not very bad, but inflation continues to decline. It is the speed at which the economy slows down. That is what the Fed is looking at. The economy slows down. That's when the Fed that'll bring inflation down, and that will give the Fed can stop raising interest rates. But if you look at the economy, yes, there are parts of the economy that are slowing, but when you look at what is going on with unemployment at historic lows, you're looking at some banking problems out there, you're looking at people are still spending, retail sales are still okay. As long as people have jobs, they'll continue to spend, and until unemployment starts to go up, that's what puts the fear of a recession into people, where people worry about, well, I might not be able to pay this bill, so I better not spend. That's the only reason why people will stop spending. But right now we're still spending, and the economy is muddling along. It's sputtering along. It's not slowing down dramatically, but it's not going up. It's sort of slowing down. Plus we're seeing China that is also slowing down. Looking at the Fed, cycles typically break things. Whenever interest rates go up, something happens. Somewhere, it put stress on the system. You saw the subprime crisis in 2007. We saw, the tech bubble. And now we've got regional banks that are in trouble. As I talked about today with David Ellison, who's one of the most tenured financial analysts in the country. He's been doing financial analysis on financial stocks for 30 years. He was on the broadcast today. You can just go listen to the podcast where he talked about what is going on in the banking sector, and if there are more banks that are going to go belly up. I don't think there's a lot of banks that are going to go bankrupt at this point, but things can change depending on what happens to commercial real estate. If the people cannot make their loan payments, then they have to take this commercial real estate back, and then they have to dispose of it. They have to take losses on it. That we don't know yet. That's a cycle that we'll have to see. The market, again, first quarter Q1 earnings, better than expected. Again, I know the bar was very, very low, but the economy is not going off a cliff yet. So why would the Fed stop raising interest rates? But I think they've done enough. We are going to see some tightening because the banks will be very hesitant in lending. That should basically cause about a 25 to 50 basis point increase in interest rates, or that would be equivalent to that, the Fed doing that. So I think the Fed is going to stay in June. Earnings are okay. They're not going off the economy. You can see that inflation trends to rise and fall in the same pace. You can see that the last 5-6 cycles we've seen, they've been just about the same. And you can see that we've seen this top right here, and we've rolled over right here, and it continues to come down. But it'll take some time for interest rates to come down. Estimated supercore CPI month over month, top line contributors, you can see water and sewer collection, medical care, transportation, recreation. Those are some of the biggest pluses right now. But again, core rate is slowing down. I think it'll continue to slow as we go into the fall. Consumer sentiment still is very, very negative. Why? People are worried about the debt ceiling crisis, the debt talks, the debt ceiling, if you're going to raise it or not, if the company, again, this is just political drama. Something is they'll figure it out at the end, but we should get some spending cuts. That I think the market would take that positively. If you don't get the spending cuts, that would not be good. Remember, on the 23rd, I'm going to be in San Jose. I'm doing 2 seminars. The one for the dinner is full, is packed already. We still have some spots available for the lunch seminar. I added the second one, so I will be there all day. I'll do 2 seminars. They're absolutely free. Come and learn. If you want to really find out how to really set a path to create wealth, then I will show that to you. I'll show you what works. Instead of chasing this and chasing that and going off in this direction, buying crypto, selling crypto, now going into AI and all of this, it's just you want to buy good stocks at good prices, have a solid plan, and be able to execute it. That's how wealth is created. I'll show you that roadmap. Come to the seminar. Looking at the technicals, still stuck in this range of 4,200 on the top, just about 4,000 on the bottom. And 4,060 is the 50-day moving average. 42, this is the gap that I've talked about for months, since August of last year. It is between 4,200 and 4,218. If we can get above 4,218, that's this low right here, then we fill this gap, and then the next target becomes 43.25. But first we got to get above 4,200. As you can see, since the beginning of February, when we made these highs right here, 4,200. We've gone there a couple of times, right here, and we fall back down again. So we are sort of biding time, going sideways here until we get some clarity on the debt ceiling. If that's raised, if you get some more good news, I think that would be enough to propel the market. Which way will we break on the downside? We've got support right here at 4,000. We break that, the 39.75. Which is the 200-day moving average, this line right here. And if we break 39.75, then the market is in trouble. We're looking at 3,800 again on the downside. But I think still 4,200, I'm still biased to the upside. This is wave 1, 2, 3, 4, and we're in the 4th wave right now. And then we'll make wave 5, which should take us somewhere around here, which is my target on the upside in the S&P. Looking at the Nasdaq weekly charts, 4,200, again, critical number. That turns us positive for the much, much longer term. As you can see, we turned negative right here. That was April of last year, and then we bounced around. Now we come back up and still in this range overall. If we can get above this gap right here, then we're headed to here. If we can get above 40, then we're looking at this and this, but that's still, first we've got to get above 4,200. Nasdaq looks a little bit better. As you know, I've had this target of about 12,600, just a little bit about below 12,600 to 12,750. We put that out. Again, we've exceeded the February highs. Here you can see we've broken out above these, which is a good sign. Support 11,950, then 11,500. Resistance 12.6. I think we get to 12.6. We're 12.389 as I'm doing this broadcast. Nasdaq looks a lot better, as I've said for the last couple of months. And Nasdaq could pull the S&P to the upside, but again, we'll have to wait and see if we can get above 4,200. Looking at the weekly charts, the dot plot is still positive as long as the dots are below the market. This is the market. These are the dots right here. That is a positive market. Coming back to the upside, if we can get above here, then we can look at about 13,000 if we get above 12.6 to 12.7. Looking at the 10-year note, interest rates hit today 12.547. This is 5.7. This is right here is resistance right here at the 200-day, just going back and forth. Again, rates, everybody's expecting rates to be coming down in the second half of this year, or the Fed to cut rates. Why would the Fed cut rates? If we are in a deep recession. I don't see that as a positive for the market. If we're in a deep recession, earnings are going to evaporate. Yes, the Fed will bring rates down, but in the short term, I think if we just get a slowdown, that would be good Fed does not have to lower interest rates. We can live with this. And gradually, as the economy slows, the Fed can bring rates down, maybe early part of next year. But you can see that historically, when the Fed pauses after raising interest rate, it stops. Usually it takes 9 months before they start cutting rates. So that would be in the first quarter of 2024. And you can see that during that time, the market goes up nicely. You can see then when the market has a negative year, the following year is usually very positive. If January is positive, there's a 90% probability the market will be positive the following year, which it is this year. Gold hit the 2085 area. It looked at a fifth wave high. After that, we've come down. 1985 is the 50-day. We're trading in 1991 right now. If we break 85, then we get could come down to 1925 or even as low as 1870, 1830 or so. But I still think I like gold on the long side. There's a lot of uncertainty and people are still looking at the gold market. Again, if you want to attend the seminar, go to compak.com/seminars right here. You can see that at the bottom of the screen. You can go to those and you can click on compak.com and make your reservation. It's absolutely free. Looking at the week ahead, I think the markets are going to wait and watch and see what happens with the debt ceiling talks and see if we can get an agreement on that. I think we will, but it'll be at the last minute. There's some more talks scheduled this afternoon. We'll see how those turn out. That's all. Those are my views. Those are my thoughts as of this week. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compak Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compak Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.